Most people think they're doing fine for retirement until they actually run the numbers. Having $87,000 saved might sound decent, but it could only stretch for a couple of years due to healthcare, inflation, and living expenses. Even with Social Security, that cushion begins to look thin, leading many to delay retirement or work longer than planned. Retirement shouldn't feel like a race against time or survival. It should feel like freedom. Let's explore a simpler, lower-stress plan designed to provide a dependable income. $2,800 every month. This plan works whether the investing journey starts in the 30s, 40s, or even 50s. And it only takes 3 index funds. That's it. Before diving into the portfolio details, it's worth understanding why this approach matters. Let's be brutally honest about what retirement looks like today. Right now, the average monthly Social Security payment is around $1,953. Even at age 70, benefits max around $2,500. Here's the problem. Retirees typically need between $3,200 and $4,500 a month to live modestly. That means covering housing, utilities, groceries, healthcare, transportation, and a bit for meals or visiting grandchildren. Where does the extra money come from? Relying solely on selling shares to cover living expenses can be a slippery slope. A market downturn may set back retirement by years. What if retirement income could come in month after month without selling a single share? That's where index funds step in. Think of index funds like owning a slice of the entire economy. They provide exposure to hundreds or thousands of companies. No guessing, no stress about picking stocks, no sleepless nights tracking earnings reports or chart patterns. Many index funds pay dividends, real cash regularly, not from selling shares or reacting to market swings. But this is where some people veer off track. They chase high-yield ETFs with flashy dividend payouts. On paper, it sounds incredible, until a recession hits. Suddenly, that income dream turns into a financial panic. Others try picking individual dividend stocks. Sometimes, they get lucky. Other times, they grab the wrong stock at the wrong time. It turns into a retirement strategy built on guesswork and volatility. Then there are those who go all in on REITs or sector-specific ETFs. Powerful tools, but they come with wild swings and tax headaches. For the everyday investor who wants something simpler, steadier, and stress-free, index funds hit the sweet spot. They're diversified. They ride out market storms. They're not always flashy, but they're consistent. And when it comes to retirement, consistency wins. To get the most out of this strategy, 2 foundational tools come into play: tax-advantaged accounts and dollar-cost averaging. Tax-advantaged accounts, like a 401k, 403b, or Roth IRA, are game changers. With a 401k, money goes in pre-tax. That lowers taxable income today, and all investments grow tax-deferred. Taxes are only paid when the money gets withdrawn later, ideally in retirement when you're in a lower tax bracket. With a Roth IRA, taxes are paid upfront. However, growth and dividends are 100% tax-free forever. Using both allows for a balanced tax strategy, more flexibility in retirement, and the ability to let more money compound. The second key is dollar-cost averaging. Invest the same amount regularly no matter the market state. This strategy takes emotion out of investing, helping you avoid buying high and selling low. Together, tax-advantaged accounts and consistent investing make this strategy nearly automatic. Not just any index funds will do. The ideal picks need to check several boxes: a reasonable dividend yield, strong performance, low fees, broad diversification, and a history of increasing payouts. It's not about chasing the highest yield. The sweet spot for dividend-focused index funds falls between 1% and 3%, ensuring stability and reduced risks associated with extreme yields. Even more important is the dividend growth rate. A fund that consistently raises its dividend means income rises without additional investment, illustrating the magic of compounding. Too many get distracted by high yields that crash with economic stumbles. This strategy focuses on funds that have proven their ability to adapt and are backed by strong companies. Think of it as building your income on bedrock instead of sand. This approach leads to sustainable financial health over time. A 1.8% yield with steady 10% annual dividend growth can turn into a dependable income stream that feels effortless. While others may panic during a downturn, this portfolio just keeps going. That's the piece every retiree deserves. Every 0.1% in management fees is money that's not compounding for you. Fees matter more than people think. Diversification is key, not just across companies, but across sectors and geographies. Relying only on U.S. stocks is limiting. It's about stacking the odds in your favor, using funds designed for the long haul that grow, reinvest, and repeat. Here are the 3 index funds at the heart of this strategy, building a $2,800 per month retirement income while growing a 7-figure nest egg. This fund is a dynamic, time-adjusting portfolio. It starts off with a growth-heavy allocation and gradually becomes more conservative as the target year approaches. Over the past year, it's returned 12.64%. Over 5 years, a solid 50.81%. And over a decade, it's nearly doubled with a 93% return. Its holdings are concentrated in large-cap U.S. stocks, international equities, REITs, and bonds, all wrapped up in one simple package. With a 1.9% dividend yield, ultra-low 0.08% expense ratio, and built-in rebalancing, this fund brings both growth and stability to the table. It takes care of the rebalancing automatically, shifting the weight from aggressive growth to more conservative holdings as time goes on. That means less stress, fewer decisions, and more time focused on life, not markets. With Schwab's own ETFs, the internal costs are kept incredibly low, meaning more money stays invested and compounding. This fund has weathered serious storms, COVID crashes, inflation shocks, rate hikes, yet still delivers strong long-term returns. It's not just about surviving the highs and lows. It's about steadily climbing, even when the path gets bumpy. The combination of equities, bonds, and real estate means it isn't tied to one sector or asset class, always adjusting and adapting. As retirement draws closer, the shift towards stability becomes more valuable, balancing growth now with protection later. It's like having a built-in financial advisor that never sleeps and never forgets to rebalance. With a high concentration in tech, financials, and healthcare, it's positioned to capture gains in innovative sectors. The inclusion of bonds adds a cushion, helping reduce volatility during market corrections. It's the backbone of a well-rounded portfolio and a cornerstone in this retirement income strategy. Set it up, let it run, and let the dividends and growth do the rest. This fund puts growth front and center. It's packed with over 2,700 stocks. Its top 10 holdings, including Nvidia, Microsoft, and Apple, make up nearly 60% of the fund's value. The dividend yield is modest at 0.54%, but it's the engine that drives long-term capital appreciation. Introducing Fund 3, Vanguard European Stock Index Fund, VUSX. VUSX brings international exposure with a European twist, focusing on large, dividend-paying companies across various industries. With a 2.89% dividend yield and a 0.08% expense ratio, this fund offers exposure to blue-chip names like Nestle, HSBC, and Shell. Its performance? 13% over the past year, 44.27% over 5 years, and 52.42% over a decade. It won't deliver tech-like growth numbers, but it adds resilience and income stability during market fluctuations. Its sector exposure helps it stay grounded during market storms, benefiting from industries like industrials, financials, and healthcare. VUSX spreads its bets across Europe's stable economies, tapping into companies with a history of paying dividends. It's not about making headlines. It's about being the steady performer in the background of your portfolio. By investing in VEUSX, you reduce the risk of being too US-centric. If the American market has a bad year, international holdings like VEUSX help cushion the impact. Plus, the low expense ratio means more income stays in the investor's pocket, not with the fund managers. VUSX brings quiet strength to this strategy, balancing out volatility and delivering income when it's needed most. Now that the three funds are in place, it's time to look at how they can be combined to create different portfolios tailored to different stages of life. This portfolio is built for those in their 30s, people who've got decades ahead before retirement and want to maximize long-term growth. Half the portfolio, 50%, goes into FNCMX, the growth engine. While the dividend yield is low at 0.54%, the share price appreciation averages around 15.27% annually. Next comes 30% in SWYHX, bringing stability to the aggressive strategy with a 1.9% yield and 13.49% annual dividend growth. The final 20% goes into VEUSX, delivering a healthy 2.89% yield and adds international diversification. The growth engine portfolio produces a 1.42% dividend yield and annual share price growth around 10.64%. It's aggressive, but perfect for young investors. In year one, with $800 a month invested, the portfolio may not look like much, but by year 10, it could yield $2,000 in dividends. Fast forward to year 20, nearly $10,000 in dividend income and a $720,000 portfolio. By year 30, income grows to $34,000 a year, and the portfolio value exceeds $2.4 million. That's the power of compounding. For investors in their 40s, this balance is split: 40% SWYHX, 40% FNCMX, and 20% VEUSX. This combination results in a 1.55% dividend yield, an 11.46% dividend growth rate, and a strong 9.86% annual appreciation. It delivers compounding and consistency in equal measure, just what's needed with 15 to 20 years still left until retirement. To follow this plan, it would start with about $100,000 already invested, plus an additional $12,775 contributed annually. In the first year, dividend income starts at $1,554, and the portfolio ends the year at around $124,187. By year 10, dividends climb to about $8,000, and the portfolio hits $517,000. At year 20, dividend income reaches $34,000, and the portfolio pushes past $1.8 million. The mix here is 40% VEUSX, 30% SWYHX, and 30% FNCMX. The higher allocation boosts the dividend yield to 1.89%, with a dividend growth rate of 11.89% and annual appreciation of around 8.36%. To make this strategy work, it begins with a $450,000 portfolio and contributes about $14,600 a year. In year 1, dividend income starts at $8,496, and the portfolio ends just above $510,000. By year 5, dividends hit $16,000, and the portfolio grows to $828,000. By year 10, dividends climb to $34,000, and total value reaches $1.47 million. That income level means no selling shares, no worrying about market crashes, just consistent income month after month. For someone within a decade of retirement, this setup can be the bridge between uncertainty and freedom. This approach keeps retirees from being at the mercy of market volatility. Instead of reacting to financial fear, they respond with financial strength. The money is working in the background, quietly building momentum every single day. Unlike a job that ends at 65, these dividends don't retire. They keep going, growing, and delivering peace of mind into the golden years. The path to consistent retirement income and millionaire status is real, but it depends on time, consistency, and letting compounding do the heavy lifting. A 30-year-old can build a $2.4 million portfolio with just $800 a month, turning into a $34,000 per year income stream. A 40-something starting with $100,000 can hit nearly $2 million in 2 decades, covering retirement living with ease. A 50-year-old with $450,000 can double that in a decade while earning dividend income that rivals Social Security checks. This process doesn't need a 6-figure salary or a financial advisor. It requires a reliable system working in the background. No need for stock chasing, panic selling, or market predictions. What you need is discipline and a growing portfolio. Even in bad market years, dividends from quality funds keep arriving. Those checks can mean thriving, not just surviving in retirement. It's about building a system that ensures your money lasts, providing peace of mind as you invest. This strategy is powerful due to its simplicity and focus on consistency, minimizing risks without complex strategies. These 3 index funds work together to provide growth, income, stability, and international diversification. There's no guesswork, no scrambling to sell during a downturn, just steady progress toward a financially secure retirement. Retirement doesn't have to be scary. It doesn't have to be delayed. It doesn't have to mean sacrificing the lifestyle that's been worked so hard for. It just requires a plan that works and a strategy that's been tested. Whether in the 30s, 40s, or 50s, it's never too late to take control. With the right index funds, a consistent investing habit, and a long-term mindset, the dream of living off dividends becomes a reality. $2,800 per month in income is just the beginning. It brings peace of mind, options, and freedom. If this strategy resonates, share it with someone who needs to hear it. For more breakdowns, calculators, and visual guides to help navigate the road to financial freedom, make sure to subscribe and hit that notification bell.